Good evening. Why did that? Damn, already getting technical difficulties.
2020 problem.
Oh, that's why. No, we're good. Sorry, it's playing in my background. Good evening, everyone. Welcome to the Real Estate Investing Incubator Meetup Group. Well, virtual meetup group, actually, but that's all right. There's lots of different ways that we can still be able to all chat, meet up, get together, even if it's just virtual. We're going to get started in just a second here. And obviously, we're going to have a lot of fun tonight. We want to keep this as interactive as possible. So a few quick things. If you could do us a favor, however you're watching this, however you're enjoying this, however you're with us tonight, do us a quick favor. If you can comment what area you're located in, so your geographic area you're located in, as well as what strategy, what real estate investing strategy are you currently concentrating on? Are you a landlord? Do you do fix and flips? You wholesale? Are you a realtor? Are you a lender? Whatever the case is, if you could comment that, that'd be super helpful as we go through the presentation and we kind of all intermingle and just go through stuff in general. So here's the quick itinerary for tonight of how we're going to set this up. We're going to bring on Ian Horowitz in a second, and he's going to go through a case study, step-by-step apartment building investing. He's actually going to break down an apartment building that he recently purchased, so we can go through that with him. And he's going to kind of, as he goes through the process of how he located the deal, we're going to go over some ways to locate the deal, how he got financing, how he does property management, how he does construction, things like that. So we're going to go through all of that. And towards the end of the presentation, when he talks about financing, we're actually going to bring Jason Schwartzberg on as well, related to some energy efficient financing tips and some structures that he actually helped Ian with in this project, and he can also be a good resource. So along the way, we're obviously going to do Q&A for as long as we can with everybody, and we want to keep it as interactive as possible. So there's a few different ways that we can do questions and answers. You can either comment however you're watching this. So right now, this is streaming on multiple Facebook pages, LinkedIn pages, YouTube pages, embedded into our website. So there's a lot of different ways to do so. So we're going to try to go in order. There's already a lot of kind of comments coming through. But again, just like any offline meetup group, we want to kind of keep this interactive and go through as much stuff with everybody as possible. So comment all your questions. And also, we're able to bring you actually on screen with us to ask your question live in front of everybody. So that's another option. If you want to do that, in a second, I'm going to post, and throughout this presentation, I'm going to post a link to do so. All I ask is you click on the link, you'll get put into a waiting area, and then as soon as you get into that waiting area, there's a link on the right that says private chat. Just chat us your question ahead of time so we can make sure we put you on when it becomes the most relevant. And yeah, we're going to have a lot of fun. Chris, you got any quick announcements before we bring up Ian?
Yeah, just a couple things. I mean, first of all, thanks everyone for being on. It is our first meetup in a while. We did a virtual one in March, and then obviously offline ones for many months and a few years prior to that. So thanks for coming back to the Real Estate Investing Incubator, sponsored by our lending company, hardmoneybankers.com. Hope everyone's doing well, personal and business-wise. Fortunately, during a tough year, residential real estate has done very well. So we're all thankful for that. Many people have transitioned more to working remotely than in the office or in the field like before. But, you know, we're all getting by. We're all doing our thing at HMB, all of our clients, everything else. So hope you are as well. And yeah, that's about it. Thanks again for being on. And should we turn over to Ian? Get moving?
Yep. Ian, how are you?
What's up, guys?
What's going on?
Hey, man.
All right. Just laying low. Excited to join you guys. I feel good to be back in a meetup group. It's been a while since we've had one of these. Usually, I look forward to the drinks afterwards. So I guess we'll have to virtually do some drinks afterwards and get all the real deals.
Fair enough.
I don't see why not.
Hey, so let's just do a real quick intro about yourself and about your company, and then I've got your presentation here. I'll pop that up on the screen in a second, and we'll go from there.
Yeah, for those that don't know me, I'm Ian. We invest local here in Baltimore. We have approximately 200 units between single family and multifamily properties. We're mostly in the affordable space. We're both, me and my partner Dan, we're both firemen full time for the city of Baltimore. And we got involved in real estate investing about 6-7 years ago and have grown a portfolio and want to be able to give back and share as much information as we can about it. So, we don't want everyone should be able to do this and accomplish it,
Yeah, no, absolutely. So we're going to let you kind of go full throttle. Let me get some of this stuff off the screen to keep it a little bit cleaner. I'm going to let you kind of run point with your presentation. And then if I see any questions that come in that are kind of relevant to this right now, I might interrupt you to hop in, but we'll try to keep questions kind of towards the end. But feel free if you have questions to chat them along the way, and we'll be going through them and plucking as many as we can and doing our thing. So yeah, do your thing. Hopefully everyone can see the screen. Comment below if you are having trouble reading this, but you should be able to see it pretty clearly. Go ahead.
Yeah, this might be the best way to. I don't know. This might be the best way to go about it, so I can keep track. Sorry, I'm running one screen from home. I don't have all my normal amenities like I do. But either way, we wanted to take the time to study the 76-unit apartment building that we recently purchased during COVID here local to Baltimore. It was a really unique deal. It's a really unique way that we found it. We're going to touch on some of the key points of, how to find apartment deals, construction, and we have a big secret financing tip that we're going to bring up towards the end. We're going to have a special guest come in and discuss that. So you guys can see, it looks very presentable from the outside. We'll get into what the seller, what she had going on. And here's a foreshadowing of some of the pictures of what it looks like on the inside. So here's a quick background on White House Manor Apartments. It's a 76-unit apartment building. It's located in the northeast section of Baltimore City. For us, this property was a perfect candidate for doing a value add proposition. A few ways, we were able to add value just from looking at it on day one was through property management, through stabilizing the rent roll, stabilizing the expenses, and ultimately renovating the apartments to increase the rent amounts each month, which will ultimately increase the NOI. So a lot of the times we get a question, asked is, how did we find the deal? This one was actually really unique. We had a local wholesaler contact us. And I remember getting the phone call. He's like, hey, it's Shane. I want to let you know about this deal we have upcoming. The lady's realistic. She wants to sell this 76-unit property. I'm like, well, there's no way that, you have a 76-unit apartment building and not one of the brokers know about it, that it's available on the marketplace, off market. There was like a lot of red flags to us that were like, how is this even possible? But, that wholesaler had forged a relationship with this seller, and she had a relationship with them, and they said very maturely that this is not a deal for them. They don't want to be involved. So they reached out to us and a few other groups. The seller actually saw our book that we had released subsidized. We were doing a bunch of marketing for that. And not only myself, but a few other groups. She was very in tune with what was going on in the Baltimore marketplace. So she said, hey, guys, I want to talk to these few people. And we would love to, interview each of those groups. And it was real important to the seller who she was working with. That was actually one of the key metrics. It wasn't just who's going to pay me the most amount of money. It actually came down to who she felt the most comfortable with, and who she felt like she could have a long-term relationship with, because ultimately she wanted to owner finance a good portion of this deal. So money wasn't the most important thing to her. Actually, who was running the deal was way more important to her. And what had happened is that she had interviewed us and several other groups, and we actually didn't win the bid. And just through follow-up, we were working on another deal. I reached out to the seller. I said, hey, Jane, we're working on this other deal. Do you have interest in investing? And she said, well, no, actually, I'm having issues with my other deal. Are you guys still interested? And so by just doing, standard follow-up and following through on a deal, with commercial real estate, it seems to be, a deal is not a deal until it's done. And they left the closing table. So it was real important that we followed up, that we followed through with the deal. And by doing that, actually wound up getting the deal. So I will say 100% follow-up on this deal is what won it for us. And none of this would have happened if we didn't have any presence in the marketplace. That was very important, that, if she didn't know about us and know what we were doing by doing these events and presenting, even just talking to other people in the marketplace, nobody would know who we are. And that's ultimately won the deal. And now this is not as traditional as what you would find in most commercial buildings. A lot of people automatically go and look for brokers or on-market deals, but it's the same exact thing. Once all the brokers heard that we were buying this deal, all of a sudden they all started reaching out saying, hey, we got these other deals. So it's important, not just on off-market deals, but even on-market deals, to be talking to brokers and realtors and other people in the business. Just tell them what you're doing, what you're up to. Sure, I can put it on presentation mode so it's a little bit easier to read. So ultimately, you know what's going on, or so they know what you're up to. And that ultimately will hopefully facilitate a phone call. I don't know how to move now that I'm in this mode.
Hey, Ian, a few quick questions for you. So on a project like this was your strategy. This is, for instance, the strategy that worked to get this property under contract. And I know you kind of mentioned that it was a little bit untraditional, but I don't think it is. I mean, I think a lot of deals are had kind of through relationships, not necessarily with the seller, but it's just a relationship in general with somebody who knows the seller or has an in with the seller or something like this. Like, what are other ways? And maybe this is similar. I think a lot of people invest in single units, and I think there's a lot of similarities. But what are other ways, kind of, because this isn't the only project you have, right? This isn't the only apartment building you have in general. Like, what are other ways that you found deals in the past besides the way that this one potentially worked?
Yeah, so for a purchase that we have upcoming, the broker said, hey, I know you're in the marketplace. I know what your appetite is for other deals based on other deals we've done. Do you have interest in this? We have another deal that we did a case study on before that we actually, the property manager was managing the property for the lady, saw how much she was struggling. She wasn't reinvesting into the deal. She wasn't making the property better. It was a headache for him. He finally went to her and said, hey, do you want to sell this property? I think I know a group of guys that'll purchase this. And we wound up getting a phone call about that. Even though she paid a broker fee, it was really off market until it was time to close. So I would say there's a few different ways, between contacting sellers, contacting brokers, contacting property managers is always a good one. And that's both single family and commercial, right? Like, it doesn't matter what space you're in. If you're not talking to people, you're not going to be able to find the deals. And that even worked in the single family world for us too. When we were actively buying them, we would have guys, realtors, guys and gals call us all the time and say, hey, I know the bank's unloading this property. It's coming to market. Do you guys have interest? Knowing that we're in purchasing mode. So does that help, Jay? You there?
Yeah. Sorry, I forgot you can't see me because you're in.
Yeah, no, I can't. I'm in the other.
Yeah, we're good. Keep moving.
So real quick, by the numbers. So what we saw once we got the phone call was that we saw it was 76 units. It was about somewhere between, don't quote me, I was trying to dig up the numbers the other day, but I think it was somewhere in the 85% occupied. That was a physical occupancy. That doesn't mean how many people are actually paying. For our investors, if you look over here to the right, that's what the leverage to IRR is. It was a little bit higher than that, but for round sakes, this is what it is.
You want to jump to the next slide real quick? Because I think you're talking about the next one, to buy the numbers.
Yeah, can you not see by the numbers? What the heck is going on here? How about that? You didn't know. All right, yeah, so 76 units, 85% occupied. 17, 18% leverage return for all of us that were involved in the deal. How were we going to increase value is, between increasing rent amounts, renovating the property. And I think a key metric to making this whole deal work is that there was cash flow in place. I don't think enough people put enough value on that to say that there's actually cash flow in place. Even if the property just breaks even on day one, at least you're paying your bills and you can go in and stabilize it. You don't have to lose money to do the deal. Can you guys see the next slide?
It's still by the numbers. There you go. Value add opportunities.
Okay, yeah. It seems like you guys are just a few seconds behind me. So what were the value add opportunities when we were looking at this deal? One of the main things that stuck out to us was the top one and the bottom one. And this is in no order, obviously, but below market rents was one of the big ones. I think marketplace rents, they were getting, just sub $800 average. And today we're closer to $1,000 average. So by knowing our marketplace, and I think this is a strong case for investing in your own backyard versus investing in another marketplace, is that, you have better market knowledge, you have better market data, and you might be able to push the rates, and part of the problem with the below market rents was the owner necessarily wasn't pushing up on the manager because there was a stress there. And then the manager didn't really, even though they get paid more when there's more rents coming in the door, they weren't necessarily pushing it because they're like, well, it's easy. I can just keep the occupancy up. I can rent at $7.95 all day. Who cares? And I'm still getting paid the same, right? So that little metric there between the seller and the property manager having that issue ultimately caused the property, I don't want to say fail, but it wasn't keeping pace with what was going on in the marketplace. And the seller, another reason there was a value add opportunity, the seller had owned the property more or less since it was built, since the 60s or late 60s. The seller, she wanted to own or finance the majority of the property to avoid capital gains. She didn't want to retain the property, mostly because there was this huge stress with the property manager. And she's like, look, if I can just get a consistent monthly payment, I'm good with that. I don't really need to get into this whole renovating the property, trying to increase NOI. I just don't want to do it. I want to owner finance the property. And actually, when we were going to buy the property, we said, hey, seller, like, that sounds good and all, but we'd rather go to a bank because we could finance all our construction money. And she said, no, I'm owner financing it where you guys are out. So that was actually a huge value because she was willing to owner finance almost 90% of the deal, or actually 90% of the deal. So that actually reduced the amount of cash we need, and it was more value to everybody that was involved.
Ian, question for you. Do you think in general, what type of, because I know people are gonna be like, oh, wow, like I can't do that. Who's gonna seller finance, a whole deal for me? Like that's very, very rare. And it may not be, like, in general with your experience, what type of, is owner financing, something that happens frequently, or is that kind of just,
I would say it's more frequent in the commercial world, because you got a lot more B2B. You're not dealing with an owner dealing with a business operator trying to get the best deal. You have two people that are in a that want to sell, and one that wants to buy. They're both in business. They both understand the metric of money. So I think there's more of it in the commercial world. I'll say if you don't ask, you'll never know, right? If you don't put yourself out there, you don't ask, you don't bring it up. Look, I'll be honest. I'll tell everyone here on this screen tonight that's watching or whenever they watch this, this is a unique home run deal. This is not the normal by any means. The likelihood of a seller holding back 15, 20% is realistic if they can get comfortable with the idea of potentially being in being in second position. But ultimately, I think most sellers are potentially open to it if you understand the tax benefits, if you can pitch to them, I hate to use the word pitch, but if you can show them the way of how they're actually potentially increasing the amount of money they're getting by owner financing, right? Because they're earning interest on this money. So I think if you can make your case, there's a lot of times that owners will be interested in that. But I can't say that it happens all the time.
Well, yeah, but let's talk about this for a second, because in general, most deals are win-win. And I mean, I know a little bit about the background, so I can kind of fill in a little bit as well. But, the seller accomplished what she wanted out of this. This was a true win-win. You didn't take advantage of her. She didn't take advantage of you. It was a win-win. And in general, to you, based on your business model, it was a home run. For somebody else, it might not necessarily have been, and I'll explain why. The reason that I believe you think it was a home run is because there was a huge value add component that really enhanced the value. If someone, the way that the number sat as is, were okay, right? They weren't anything crazy, right? They cash flowed, but it wasn't anything crazy. So I think potentially it depends on what people want. If someone wants to just, jump in on an income producing rental property that doesn't have any headaches, that doesn't need any more capital improvements, that's cash flowing, they don't want to get into the construction component. They just want to get a bank, they want to get a bank loan at cheap terms and put the rest of the equity themselves or raised equity up. Who knows if this was actually the best deal? I think in your case, because you guys have a big construction component and value add component, it worked. And on her end, like, she had the building free and clear, right? So she could have very easily just thrown a bunch of capital into it herself if she wanted to, and then increase the value. And also, the whole seller carryback financing, I mean, there's a big benefit for her in that case. Instead of her getting one lump sum of whatever that was, $4 million, she can take that over in smaller increments throughout the life of the loan, which is better for her anyways, right? Like, she didn't have, don't get me wrong, like $4 million to anybody in their pocket is a ton of money. But again, if she has to give up half of that or a big portion of that to taxes anyways, in her mind, it was like, you know what? I don't know how much you're paying in interest every year to her, a few $100,000, I'm guessing. But to her, it's like, hey, I'm getting a few $100,000 and I still have a lien against the property and I'm still collateral based. So I'm not stating that it wasn't a strong deal. I believe it's a strong deal. I believe it's a very, very strong deal. But I do believe that, if someone is out there trying to structure opportunities, they do exist.
Yeah. And I think part of it is that, one point that you're glancing over, when you were talking about the fact that the seller was being clear, that made this situation way different. She was also navigating some family issues on her side that she wanted to protect her interest. And again, you don't know what the seller's got going on until you say, hey, have you ever considered owner financing? And they might say, well, am I going to get taxed different? Like, right, there's a key metric that you could present about owner financing and potentially how the tax works. Always consult an accountant. Number two, what are you going to do with $4 million when you get it back, or whatever the amount, even if it's $100,000 you're buying a house, it could be $20,000. What's the seller going to do with that money? They might say, well, I'm not going to put it anywhere else. I just want it to work for me. Right. So those are some two key facts to when it comes to, seller financing is, I would just say, if you don't ask or you don't present your case, you'll never know what the answer to it is. What Jason was saying about the building was free and clear, because I talked to her at length about it, even leading up to closing, which most people would say, well, why would you even say anything? But, look, again, like I told you, the seller was very realistic. She wanted a relationship. And we're willing to talk to her and say, hey, what's going on? I really did dive deep and say, hey, why did you not just put the money into it, renovate it, replace the windows, increase the value, and get out? And she 100% told me over and over and over again, the number one issue was the fact that the management company was a pain point for her. And I think some of this relates back to, how do you get owner financing, or even getting a deal, is if you don't understand the pain points to what the seller has and you can show them a path to a resolution, to the promised land, to whatever you want to call it. I was on a call yesterday, I was listening in, and this was actually the exact topic was, if you can't take your seller down a road and say, wouldn't it be great if you didn't have the pain of this property manager on your side anymore, and you could spend all the time with your mom and deal with your family issues? Wouldn't that be much better, knowing that you have X number of dollars coming in per month, right? Like, you're wrapping that whole thing together, and you're presenting your case. So to get back on topic, because I'll go so far off topic and we'll be on here till midnight, is that the fact that the property was being mismanaged. There was a major pain point between the two. The property manager and the seller were beefing. She didn't feel like dealing with it. And we knew we could come in. It was local to us. We had economies of scale. We could come in here and manage this property. Yes, it was the biggest property we've ever managed, but we knew we could do it. Come in here, manage property, and get the value out of it that we need. And just by, watching looking at the old statements, seeing how much money was getting burned up, and how much money they were losing on a few different things, it was like, okay, well, we can go in here, stabilize expenses, we can stabilize rents, we can, make the efficiencies of the rent, and get this thing rocking and rolling. So,
hey, quick question about that. Quick question about the value add, since we're on that, and you might be getting to this later, but so this property was acquired in June of this year, is that right? Is it June?
Correct.
Okay. Are you going to break down the value add stuff that has happened in between then and now?
No.
Am I skipping ahead?
No, I didn't get that deep into the weeds because I know there was going to be some time constraints at the back end. But some of the value add things that we've done immediately from June until now, one of the major things has been able to go in and just turn apartments between the vacancies they had, between the people that weren't paying. We were on the move with turning units, but something that immediately that tenants recognize is improving the exterior between signage, the roofs, as much as repainting the parking lot, restriping the parking lot, painting the curbs, making sure the trash is taken out. Some of this stuff's nitty gritty operational stuff, but it's all capital improvements that the tenants notice and they're like, oh, these guys are putting money into it. We got delayed on windows because there's a back order because of supply chain issues, but either way, windows are coming in, just like all these little things that they see the contractors there, they see the work being performed, they know what's happening, and there becomes a pride of ownership. We've already had some tenants just say, hey, I know you're improving that other unit. I'll gladly pay more. How about I just move across the street? That's a win-win. No marketing dollars to find a tenant, and you get another free unit to lease up or to turn over and then lease up at a higher value. So some of the capital improvements we're doing, and we'll get into how we finance some of this stuff, is replacing the windows, replacing the roofs, renovating the units, as you guys can see here to the right, the paint, the flooring, update the baths. Nobody likes that green tile anymore, although if we leave it in long enough, maybe it'll come back in style. Update the kitchens, improve the common areas, and fixing the parking lot and the outside common areas. Again, just these little things, and the tenants seeing, even just having the vans there from the contractors, even just doing estimates, the tenants notice all this stuff. So this is what we're doing for capital improvements. And then, it's pretty standard what most people would do on most single family houses. It's just at a bigger scale. One advantage we did have is that most of the AC units and heaters, indoor and outdoor units, were replaced. Most of the water heaters were replaced, even though the other day we had a water heater blow up and leak through 3 apartments. But hey, it happens. Most of the water heaters have been approved. So a lot of the heavy lifting capital improvements were done over time just because they had to be, because stuff had gotten so old. Now it's the time, to come in and do a facelift. So can you guys see the next slide? It's so hard for me.
Yep.
So how do we finance the property? And we got into this pretty deep earlier. Is that the owner wanted to finance 90% of it, for tax purposes, a lot into inheritance taxes. I think everyone that is watching today, take the time, talk to an accountant, look into it, and understand how this works for you. Now, we were able to get real creative to increase our purchase price and get hyper competitive. We were able to keep the interest rate the same. I think we landed at 5%. But something that we did that was smart on, we believe to be smart on our end, was we increased the term of the loan, right? By doing that, it keeps the monthly payments right in the target area where she wanted to be, and right where we wanted to be, just the term was a little bit longer. Sure, we could have done interest only, and we could have done a whole bunch of different things. But by increasing the term of the loan, we were able to offer just a little bit more, about $2,500 per unit more than everybody else. And ultimately, price wasn't the deciding factor, but by doing that little thing, it increased the balloon rate. And I think that was part of this, what helped us to win, besides the seller group that she had initially picked was giving her some trouble. We raised equity or cash into the deal from an investor group to complete the purchase. This could be different than most people do on single family, but it's possible to do on single family. It's just a lot easier to chop up on larger deals. So since we owner financed it, and I alluded to this before, is that we actually wanted to go to a bank, and we had to put 25% down, but we could have reduced potentially how much equity we needed, because they would have financed a lot of construction, because that's where a lot of the heavy lifting is. But what we had to do is we had to raise 10% of the deal, closing costs, and the construction money to get the deal done. Now, something we're going to get into, and hopefully Jason's here in the back room, and we'll bring him here on a second. And I think this is something that anybody that's looking at deals is huge for you, is we utilize the C-PACE loan to complete the capital stack, and it actually protected me and Dan a little bit on how much equity we were giving up. And we'll get a little bit more into that. And if we're getting too deep in the weeds, please leave a comment. It's going to get potentially a little confusing, but if you follow along, it's a unique tool that a lot of people can use to help do energy efficient improvements. Can you guys see the tax advantage slide?
Yeah, it's popping on in a sec. Let's go through a few other things related to financing, related to other ways to finance these buildings. I think in general, some people might think the barrier to entry for larger projects, multifamily or commercial, is a little bit overwhelming because they're just not sure exactly where to start, or they think the dollars in general are bigger. So they think, okay, well, I had to put down $20,000 on a $100,000 rental property. I don't have $200,000 or $400,000 if I'm buying a several $1,000,000 building. So let's talk about two things. Number one, what type of financing is available? What types of banks lend on this? Do you have to go raise private capital? Kind of other ways to do hard money lenders. And I can hop in on that question if you want, but do hard money lenders play in this space? I know from experience, being involved in some of these projects, some of the times you actually need a lot less of your own personal cash into these deals, because if you get, let's say you're buying a $2 million project and a bank's financing 70% of it, whatever that difference is, usually they don't care where the money is coming from. They're not expecting it to just be an individual sponsor or an individual owner who's just putting up the additional money themselves. Usually it's kind of a norm that you're raising private capital, you're raising equity, you're raising something as your investment group to do so. And there's lots of deals. And I know, there's particular deals that you've been involved in that you haven't needed to put any of your own money in because you're able to get other people to participate and be involved.
So, let's go through a few things. And obviously we spend a lot of time in the single family world, and we're not banning it by any means, but in the single family world, just to get a loan for a rental property, there's a lot of times you literally got to give up your, second born before they're even born, right? Like, they want to know everything and anything about you. We're in the process of purchasing a deal that we'll do a study on later, that the finance company literally was like, yep, asset looks good. We don't need any other info. Just make sure the borrowers are breathing people and we're good to go. The easy capital, I believe, in the commercial space for bank money is a lot easier. Now, I'm not saying you can have bad credit, you can have no assets, you can be completely underwater and you're going to get a loan. No, not by any means. I think there's a lot of what you do in the single family world potentially can graduate you to the next level. I think there's a lot of people out there that could just jump right into multifamily, and that are completely bankable and you'll have no issues. So as you get into some of the larger assets over $1 million, it's actually a lot easier to finance because all the banks at that point, they're more worried about the asset necessarily than they are about you. Another thing, like we were talking about earlier, it's a lot easier to chop up a 76-unit apartment building with a group of friends and family and say, hey, we need to raise $1 million for this deal. Do you guys want to jump in? And you're going to get this kind of money out of the deal, and you're going to own this much percent of it, right? Versus a single family house where you're like, hey, I need to raise $20,000 and I'm going to go to 2 people. Now there's 3 people in the deal and you're splitting up $500 a month by 3 people. It just doesn't seem worth it, right? So the economy of scale, even in this realm, plays out, by having a lot more, I don't know how to say it, by having a bigger deal and bigger cash flow and the way the capital lays out potentially on these deals actually makes it easier to chop up, and potentially as a sponsor, by the person finding this deal, you might be able to go to your group of friends and say, I'll take care of the financing. I'll take care of running the deal. You guys put this money in and you're going to get 30 or 40% of this deal. And then it makes life a lot, I don't want to say a lot easier, but, it makes it chewable, right? None of us could potentially go out and pay $5 million by ourselves for this deal. So hopefully that makes sense and alluded to what you were saying. And I do know, just talking to you the other day, I know you were running a loan past me. I think some hard money lenders will do deals of this size. I mean, is that true?
Yeah, I think it depends on the appetite. But I also believe that they're going to be similar in LTV to what a bank would be, give or take, right? So, but yeah, I mean, we've done some loans, bridge loans, acquisition loans on deals like this that are just short term because they don't, at a 13% or a high double-digit interest rate return, there's just no longevity in that. But it is a way to get a really, really good opportunity on your books acquired, and then refinance with the bank.
Yeah, absolutely.
Yeah, and what you were saying earlier about the equity raise on a larger project like a multifamily office, other stuff compared to a single family, is that the people who invest in those are very used to doing those deals. Like that is a normal kind of deal for them, right? Mm-hmm. So the kind of, whatever it might be, like a debt and equity blend, it's a very common thing for those folks. So it's not like a wild proposition by any means.
Yeah,
that makes sense.
Absolutely. A lot of those investors are looking for who's the operator, do they make sense, and ultimately, what's the return? Does that make sense? And if I place my money here, great, I get all these advantages, and we're going to jump into tax advantage real quick here. And am I protected in the grand scheme of things? And I think that's what a lot of these types of investors ultimately look for. And even if you're like, hey, real estate, I was viewing some rental properties today. Not everyone's cut out to be a landlord, right? And I think some people are better at just saying, you know what, my best resource, my best tool is money, and that's what I can bring to this deal. And others' best resource and tool, such as mine, is finding deals and busting our butt to get the deal done, right? And I think that's where there's a mutual exchange of benefit there of, hey, we found a deal, we're going to run it, you guys bring the money, and it works out, So,
yep.
Sorry. For some reason, I got to back out and then back into every slide. So tax advantages, and this goes back to the equity investors or the people that bring the money to the deal is they're actual owners of the property. They're treated like owners. And what does that matter? It matters because they get the benefits of owning a property, right? Profit and loss and depreciation. And they get the benefits. They get the wins and they get the losses. And for those that, start following these larger or any type of real estate deal, and we just did this with Jeff Cohen last week, is depreciation is probably one of the most powerful tax tools that's out there. And if you guys want to check out last week's weekly show that we did about depreciation. And it'll really show you why it's beneficial. And actually another thing that we did with Jerry a while back was a cost seg study. And that's something once all of our capital improvements are done, we'll be conducting. And again, it's just a benefit to everybody that's involved in the deal and protect their tax liability. And it's a win-win all around. So it's not only a win for the tax advantage to the seller who sold us the deal by owner financing it, there's plenty of tax advantage just by buying this deal, owning this deal, and operating it. Can you guys see the disposition slide? Boom. So what's the disposition ultimately of this property? We don't know today. We had a broker recently call us and say that they want to pay absorbently more than what we paid for it. But, they got close, but they didn't get where we needed to be. So our goals are going to go in here, continue to stabilize, execute our plan, and we can do one of two things. We can sell it, right, a few years down the road once the NOI is greater. And everyone says, well, every year your expenses get more, but that's fine. Your expenses get more, but your value, your monthly rent and everything you've done to the property is going up as well. So there's a bigger NOI, which will result in a bigger sales price. But there's a potential for a tax exposure for everybody involved if we sell the property, right? Capital gains. Or there's a better potential that we could just refinance the property once our owner financing deal expires. and we can keep it for a long period of time. If we get any cash back from the refinance proceeds, it's not taxable. It can become a legacy property not only for ourselves but all of our investors involved. And every year we have principal pay down. Even though we extended the term of the loan, the principal pay down every year, we're increasing our equity position at all times. So I guess before we jump into CPACE, Jay, you got any other comments, or Chris?
Yeah, we actually have a lot of really good questions that have come in that I want to wait till after Jason hops on and we do we talk about CPACE, but there's really good questions about how do you split the equity if you bring investors to multiple people. Definitely questions related to CPACE in general, but there's a laundry list of questions. So bear with us a little bit longer and we're going to get to all these. And keep in mind, I chatted, and actually let me post this link one more time in the comments section. But if you want us to answer your question live, just like we're all, just think back 9 months ago when we were doing the meetup at Nottingham's. You raised your hand and we answered your question, and we all kind of talked as a group, as a community. We can still do that, but you got to hop on here live with us. So if you want to do it that way, click on that link that I just posted. I'm going to pop it up on the screen here real quick as well. So this is what the link looks like. And then as soon as you hop on, if you can't get in, try again in a few minutes, just because the system can only handle so many people backstage. But after you log in, you're going to see a link that says private chat. On the right, just chat your question just so we know it's relevant at the right time, and you can hop on, or just, again, answer your question. We're still going to answer all questions that are commented on this feed as well, so we can do it that way. So yeah, let's keep moving, and then we're gonna get to questions soon, because there's a lot of good ones that have been popping through.
Is Jay in here?
Yeah, hold on, Jason. I'm gonna throw you on here.
Yes,
there he is. What's up? Let me get you a solo layout real quick, so you're the only one on the screen first, so everyone can see you. Let's go back to let me get back to the presentation real quick.
Yeah, so guys, I won't do this any justice because I'm still trying to comprehend in my little brain here. But either way, Jason reached out to us and was like, "Hey, man, I think I have a way that you guys can protect yourself on this deal a little bit more, and you can utilize some funds that are out there. It's cheaper than equity or cash into the deal that we split with the investors. And I think you guys should utilize it. This is a perfect candidate for a deal." So before we hop in, I guess, Jay, you want to give us a quick background and then just start going about CPACE. Let us know what's up.
Sure. Can you guys hear me okay?
Yep.
Cool. Yeah, so Ian and Jason and Chris, pleasure joining you guys tonight. I wish I was at Nottingham's with a beer in my hand, but hey, we'll do what we can here. So quick on me. CPACE is kind of my Sports Center highlight. I did acquisition and development financing for about 5 years. Did private real estate for 5 years, and we have our core business. We've had an energy company for 10, where we broker electricity and natural gas for about 100 million square feet of real estate. We do energy efficiency and solar projects. And this CPACE is really a combination of the three. We understand how the Chris's and the Jasons of the world think. We understand how the Ians of the world think, and we like to think we add some value on the energy side. So this was a fun deal to work on. In short, CPACE is pretty niche, right? Like, it's going to be beneficial for your ground up construction and your value add projects. And it is strictly commercial, so 4 units or more is where it's going to be applicable. So think value add, new construction, 4 units or more. I'm kind of a funnel guy. Like, let's build the funnel. We ask the knockout questions, and if we're still in, we have a viable transaction. So it was nice that Ian spoke to White House Manor and kind of set that up. It finances energy and water related improvements of a real estate project. In White House, we did roof, and that was everything: demo, shingles, gutters, trim, and we did windows as well. So it happened to be a pretty significant part of the capital stack. And Ian, if you could click on that next slide, we can show the sources and uses for the project. Okay, so we'll do CPACE. Why should I care? It can finance up to 20% of the completed value of the project. Again, this is a replacement for equity. not debt. So, get as much debt as you can on the project. You're looking at plus or minus 6%, and we'll show you how it optimizes the capital stack in a moment. The financing is long-term. It's, county specific, but this particular deal was Baltimore City. We have a 25-year term, 25-year amortization, non-recourse and non-dilutive, and we'll case study that in a moment. So next slide, please. So capital stack, it's a little small. I hope you guys can see. So we'll kind of show. It was fun. Ian and I was reading his book. He actually came to me as a potential investor in the transaction. And when you still could go out, I was reading his book at his investment book at a coffee shop and looking at the deal. And a mutual friend had introduced us, and we were having lunch. And I was getting pretty excited. I don't know if it was the deal or the caffeine or maybe a combination of both, but he was looking for about $1 million of equity. So he had, and try to follow me here, I wish I had a whiteboard, but $1 million of equity, 40 shares, $25,000 a share. So that's where that $1 million of equity plug came in. The total capital stack was 5.75 million in round numbers. As Ian has been stressing, the seller was going to do 90% or 4.5 million. Ian and his partner were going to put in 250,000, and they were raising this $1 million of equity. And you have the uses at the bottom. I think the most important thing through this C-PACE mechanism, we were able to cut his JV equity from $1 million to 400,000 because we financed. You'll see on the capital stack with PACE, we financed 600,000 of that with PACE. So that's how we got to that $1 million plug. And again, reduction from $1 million to 400 through $600,000 of PACE. Why does that matter? The JV equity, and the next slide will give us the absolute numbers here. But JV equity, you're going to pay an 8% preferred return on the JV equity. We reduced that from 8% to 6%. So there's a 200 basis point savings there. And we have it on the previous slide, which is fine. We can speak to it. If you own, for every share, sponsors retained 80% of the deal. JV got 20%. So again, we were raising $1 million. There was an 8% preferred return paid on that $1 million. We reduced that to 6% through the C-PACE. So you have a 200 basis point savings there. And then for every share on the JV equity side, you own 0.5% of the deal. So that's how the numbers come together.
So Jay, and this is where I still get lost, and let's break it down real simple for everyone involved. Let's try it like this way. Let's say, so we're buying this apartment building for whatever, $4 million. We get, or let's use round numbers. We buy an apartment building for $1 million. We're going to get 75% loan. The bank's only going to finance 75% total of the acquisition, 75% of construction. You're basically saying as long as you're doing energy improvements, what can you do with the C-PACE potentially?
How much of that capital stack can we finance?
Yeah, because you're going to need, if you're buying it for $1 million and you're going to put $1 million into this property, they're only going to finance 750 and 750. Right. You need $500,000 total to do that deal.
Right. Yeah. I mean, we could do, up to 20% of that capital stack. So that's what reduced that sponsor equity. And if you go back one slide, I think we can show that in the sources and uses. Right. So this one was 5.75. You have the seller financing. Your equity stayed the same, the 250 from the sponsorship side. And you reduced that JV equity portion by $600,000, financed it to PACE. So You had savings on that 600,000 of 200 basis points, which is about $12,000 annually a year on your interest. But I think what gets really fun, and this can be on the following slide, is prior to the PACE, you had 80% of the deal. 80% sponsor, 20% JV equity. With the PACE, you ratcheted up your ownership to 92% of the transaction because you weren't raising that JV equity for that $600,000 of PACE that we put into the capital stack. In real numbers, we took a stabilized year here, right? So, apples to apples, $815,000 of rent, $385,000 of expenses. Your NOI is the same at $430 a piece. Your first mortgage is the same at $255. Your investor pref, $1 million of pref at 8% would be $80,000 a year. In the PACE example, we had $600,000 at 6%, which is $36,000, and we reduced the investor amount from $400,000 to $400,000 at 8% is $32,000. So you have less expense. You have the same NOI. You have less expenses, which is shown on your net proceeds. So that's your cash available after debt service. You had $95,000 originally. When you utilized the PACE, you had $107,000. So that's where the benefit is there. That's where the $12,000 of savings is. And then importantly, on the investor share, you retain more ownership in the deal. You retain 92% of the deal versus 80%, which you had prior to the PACE. So your sponsor share of cash flow went from $67,000 because, again, you're going to split this $95,000 in proceeds 80-20 in a traditional example. In this example, you're going to split it 92-8 because you've retained more ownership because you raise less equity in the transaction.
Yeah, I'm going to try to break this down another way too. I mean, not that I almost just want to dumb it down a little bit just to make sure everyone's following. Ian, go back one slide if you can, just related to the original capital stack. And all capital stack is what your total kind of sources and uses are in the individual project. So I know it's a little bit hard to see this, but if you can zoom in and see it, in essence, the left side is without the CPACE, the right's with CPACE. So the left side, he bought this property for $5,600,000 for renovations, $150,000 for soft costs, so 5.75 all in. And on the left side, he had to raise equity for the most part, right? Because he was getting seller financing, or let's just say a bank was giving him money of $4.5 million. That's where they came up with. And then Ian had to come up with the rest, right? Either your own money or capital from somebody else. So on the left side, he, was without the CPACE, he would have had to raise $1.25 million. He ended up raising $1 million, putting up $250 of their own. But when you bring in the right side, it makes it a heck of a lot more attractive because CPACE came in for the $600,000, which in essence was covering all the renovations. Because that's the purpose of the program, obviously. So they were coming in, put up the 600, and then instead of them needing 1.25, they really only needed 650,000. So they put up the 250 of sponsor equity, 400 of their own JV equity, and obviously it's two-sided. Side one is less money you have to raise. That's great, but the second side is chances are any money you raise is going to be a hell of a lot more expensive than the CPACE program money to begin with. Less equity you have to give up, less pref that you have to give up.
Yeah, and you don't have to do it this way every time. It's not that you always have to, like the next deal that we're doing that hopefully closes out here in the next few weeks is that we give it the benefit of everybody that's involved in the deal, right? Because we saw the benefit for everyone that was getting in the deal and said, look, this is how we're going to do this. This is how we're going to plug away. And it's going to improve this deal for all of us for X, Y, and Z reasons. So you don't have to do it just to protect your equity. In this situation, that's just how it worked. This is one of the first deals we were doing on this scale. This is how it fell out. But on the next deal that we were doing, we said, well, let's give it to the benefit of everyone involved in the deal.
Yeah. Exactly. And again, this is just an option to do it this way, but it's, if you ask me, a great option. It's a really, really, really good option. And, for somebody who's worried about raising all that money, you don't have to. And someone who's worried about, hey, there's just not enough money in the deal to give up to capital investors, well, you can do it through this. Let me ask you a question related to CPACE, because I know a lot of the folks here are pretty local for the most part, DC area, Baltimore area, maybe Philadelphia. Is that a national program, a regional program, a local program?
Yeah, great question. So we're probably tip off in the first quarter when it comes to PACE. There's some local legislation that needs to be passed. This map, it's on our website at mdenergyadvisors.com. So you can see that, or I'm sure you guys will be sharing the slides to the group. But it's in 30 some states, mostly the eastern seaboard. You can see a little bit of the middle America and then over to the coast. But yeah, DMV, it's here. Pennsylvania, Virginia, DC, Maryland. The program is up and running, and we're lending across the country, for transactions.
Jason, question for you. For those who aren't familiar, what is the source of capital for a CPACE loan? Is it bank money? Is it government money? Like, where does that come from?
Yeah, great question. So it's all private money. So we have 5 balance sheet lenders that we represent in the market. Some of them are REITs. Some of them are fund investors, but it's all private capital that's lent in. The collection mechanism is a special assessment on the property tax bill. So I don't want to go too far down a rabbit hole, but ultimately there's a special assessment on the property taxes. A lot of your listeners are probably familiar with front foot benefits or sewer benefits here in the local market. It works very much the same way. The local municipality basically serves as the mortgage servicer and collects the funds and then repays the loan over time.
Right.
Okay, so it's, in essence, private funds, but it's collected through the property tax bill.
That's right.
Interesting. Okay.
And it's private funds that are related to the local jurisdictions that are saying it's okay to lend this money for this exact reason. So it's not just these lenders can go anywhere in the nation and say, I want to lend this out. The jurisdiction has to say, yes, we approve the CPACE money. Do you know much about why the jurisdictions have to be involved on it?
Yeah, because the lenders need to be able to involve the jurisdiction so you can get it on the property tax bill ultimately. So they serve as the mortgage servicer, so to speak, for the lenders on the backside.
Got it.
Yeah, let's go through any questions that we have. If you have any questions related to you want to keep going through? You have one more slide? Sorry.
One more slide, I think.
Yeah, let's go. Yeah, let's do that one.
Yeah, so just from a hurdle standpoint, right? Like it's a great program, but I want to stress it's niche. It's only for value add. It's only for new construction. It's only for commercial. And then there's 3 hurdles, 2 of which we can handle internally: the financial sizing and the technical review. We started off the chat with kind of the Sports Center highlight. We make this all financial, but ultimately there's an energy component to it. And we make sure that you ultimately will pass review, and Ian can kind of be our hair club for men case study on that one. And then ultimately, as we mentioned, it sits at the property tax. So we want to have the lender consent from the first mortgage lender. 282 first mortgage lenders have consented to the structure. Many of which we have relationships with, so we can help on just the pace and bring in somebody like Hard Money Bankers. We can bring in a community bank. There's a lot of different ways to structure the transaction.
Nice. No, it seems cool. I mean, I just learned about it recently through Ian, and I'm sure a lot of people here have never heard of it. But let's go through this. Let's try to go through as many questions for Jason first. And there's his contact info, and I've been kind of streaming his stuff below on the screen, and I'll comment his info here as well, so it sits here. But let's see if we can answer everything through CPACE first. Let me go through some of these. Again, if you have a question you want to hop on, I'm going to post this link one more time, but I'll go through some of these. So let's see. Can you see when these pop on the screen, Jason, or you want me to read them?
I just see Oren's question, but I don't see any of the ones.
Yeah, just that one. I'm going to do them one by one.
Okay, cool. Yeah, so PACE is typically residential PACE. C-PACE is commercial PACE. Residential PACE is only in 3 or 4 markets. I kind of just speak to it as PACE, but the C stands for commercial. Residential PACE is not available in the DMV currently.
Got it. So we kind of answered this question already, but is C-PACE only for apartments or 4 units and above? Fix and flips don't qualify. Yes, for 5+ units and commercial. Question for you. I know you said something related to construction money, for new purchases. What happens if somebody owns a property free and clear with a small mortgage or a mortgage and they want to refinance it to do renovations? Can they do something with C-PACE in conjunction to that?
They can. So my money, again, has to go towards the energy and water related improvements of the project. So the easier way to answer your question is if it's free and clear, of course, anything that's, I just loosely call it energy or water related. But again, think windows, roof, lighting, HVAC, plumbing, all of those things will qualify. You wouldn't be able to use any of my money to pay off the existing mortgage because that's just paying off the mortgage, not going towards the energy improvements. But if there's all day, there doesn't have to be an existing lender involved in order to structure the transaction.
So next question from Ryan: when can you start pulling money from the C-PACE loan? I'm guessing that's an existing C-PACE loan that's already in place. And I guess the question is after, let's say you have a $500,000 C-PACE loan in place, how and when can you start pulling funds from it?
Yeah, no, that's a good question. Probably the easier way to answer it is on a retrofit, a value add. If you're putting in, roof, windows, lighting, HVAC, like you can roll. We'll put a disbursement schedule together, a draw schedule. And as soon as you incur the energy related costs, you have access to the funding. If it's a new construction deal, again, we're not helpful towards acquisition because there's no energy related improvements. We're not helpful towards site work because there's no energy related improvements. But as soon as you start to incur energy related expenses, either on the design side or ordering equipment, you can start to draw down on the C-PACE loan.
So just like a regular construction loan, the sponsor, the owner, investor does the work first, right? And then you guys have to sign off on it, knowing that it's sufficient, and then you send them the money to reimburse them.
Yeah, we're going to want, just like you said, we're going to want the lien waivers and know that the work has been done. And yes, as soon as it comes in, we're doing some pretty big transactions, and we usually run pari passu with the bank. We can rely on their inspections and so forth in order to get the funds in the hands of the owner.
And does interest only accrue on dispersed work? So let's say you do a $500,000 and the first draw is 100. Day one there's really no interest, and then after you disperse the 100,000, you start paying interest on that. Is that the way it works?
Yeah, it's a little different because it's a special assessment on the property taxes. It technically is fully funded from day one. The way in which it's recorded and the way in which it works. So the clock does start, once we close. But we also have and we didn't speak to it tonight, but we have the ability to build in capitalized interest or interest reserve in these transactions as well. So we can give carry through construction and until stabilization as well. So our investors have found some value there.
Got it. Rupert, you got a bunch of questions. You should just hop on here live with us, but I'm going to try to get through some of these prevalent ones. So if you want to go through that one, I'm still going through a bunch of these comments and finding some other questions.
Yeah, so plumbing's really interesting. So we're doing a pretty large self-storage facility right now. And you can take if you do waterless urinals or waterless or low flow toilets and faucets, you can take the entire plumbing number. If you have a reposition or a new construction, I think the easiest way to look at it is you're going to run out of my money, which again is about 20% of the project. before you run out of energy-related improvements. So we have a really good way of structuring that. If you're doing a major reposition or ground-up construction, we'll help you with the energy side. You'll run out of our funds before you run out of energy measures.
Hi, so Edward says, what happens if you sell the property? Will the new owners be responsible for the increased property tax bill?
Yeah, so there's a couple options. You can pay it off at closing, or it's fully assumable, and there's no additional underwrite. So if Ian is grade A and I buy the property from him and I'm not, the PACE lender, it runs with the property. So there's no additional underwrite. There's no funky assumption stuff. It automatically runs with the land and stays with it. So there's some optionality there.
Okay. I think I saw one other thing related to this, and then I think that's all the CPACE stuff. And you see it? I'm just scrolling through all these.
Your lighting's the best out of everyone's.
Yeah.
Yeah.
Who's
Sorry.
Oh,
We didn't hear what you said, Ian.
I said I just want to comment and say that your lighting in the room is the best.
Who's lighting?
Yours. You're all lit
Okay.
up. Happen to know.
Yeah. Yeah.
Hey, I do see one from Shawnee CU. Excuse me. What's the maximum loan amount? But I'm thinking minimum might be more of a better question. I guess what's the min max on these CPACE loans?
yeah. So we're really looking to do loans of $500,000 and above. On the min, we don't have a max. I mean, we're currently underwriting a $25 million PACE portion. That's about
20% to the total deal, right, or something.
That's right. 20% of the completed value is the upper limit.
Yeah.
What are real big project. What are your estimate? Like, what is just a range of terms on something like this? I don't know if we discussed that.
Yeah, I think in the fives. So I would say, under 6%. There are some closing costs, figure, I don't know, 3 to 4.5%, depending upon the size of the transaction. And this is meant to be, fixed rate, long-term, non-recourse financing. So, these legacy assets, like Ian has is where it plays really, really well.
Yeah. I mean, the assumable thing's definitely kind of a sexy component to it. If you can potentially, if you decide to sell that over a period of time.
Yeah, it's less equity that the buyer has to, just like Ian had less, we went through our example, it's less equity that the buyer has to raise.
I think that's it. I think that's it for CPACE. There's a lot of questions for Ian on some other stuff. Can anyone use CPACE? I think all these, I think we got through kind of the important, relevant ones. So cool. Well, Jason, certainly appreciate it. Can you just comment your info just so it shows up under your name on the right here? You'll be able. I don't know if you can do it on your end. If not, I'll do it on my end to make sure everyone has your info.
Yeah, it doesn't look like I have access to the.
Okay. All right, I'll do it.
Go on Facebook. Go to one of our pages and just comment, and it'll ping everyone.
Just do it that way, because then it's coming from you and people can friend you on Facebook and things like that. Because if it comes from me, it's it makes it easy. Eddie, what was your question? CPACE question for Eddie. You're asking a question with or a comment related to your question. I saw your name on here somewhere, but I don't see it now.
With a property, AJ, can you facilitate all the capital, including CPACE, lending and the CPACE money on the capital?
We can. Yeah, you can probably answer that question.
Yes, the answer yes. Man is very well connected, so he would get you put in touch with the right people.
Got it. Yeah, I saw his question, but there's too many of them. I can't keep track of them. Okay. You said 2 questions above. Okay. Well, Jason, certainly appreciate you chiming in with us. Certainly appreciate it. Make sure you put all your information. And, Ian highly recommends Jason. He's been involved with some of his projects on this. And based on some of these examples, it's clearly a no-brainer if you qualify for it. I mean, unfortunately, if you just buy single families, it's not going to work. But if you buy multifamily apartment buildings and commercial, it's definitely worth a shot. So Thanks again, Jason.
Yeah, before he rolls out, though, to be clear, if you're going to build a row of townhomes and you're going to retain them for rent, build to rent, you should talk to Jay. There's a possibility that it could work.
Fair enough.
Yeah.
I mean, thanks again.
Thank you.
Thanks, Jay.
Cool, guys. So, all right, let's go through these other questions. Let's get rid of your slides. Make this look a little bit more.
You're just starting to look like
I know. It smeared them over there. All right. So, Ian, and again, let me post this stream link. If anyone wants to hop on live with us, you can get you can hop on here with us. Okay. Let me figure out what's good here. So
yeah, there is a lot of chatter going on. That's for sure.
Appreciate that. They're looking. There was a good question we got really early on that I want to start with. Let's see.
we need
What is that?
So we need a producer.
I know we do need a producer to go through all these. It was a good one that I liked. That I want to start with. If you guys, oh yeah, this one. This question from Oren. I like this question. Ian, how do you split up the equity if you bring in investors with the people managing?
So for us, it really just came down to the metric of what we thought was fair based on what was going on. If you go out and you go to like a Michael Blanc or a Brad Summeroff, where you say give up 70% of the deal and charge a bunch of fees and do this and do that, and only retain 30%. But for us, it was a tough sell to look someone in the eye, especially, like potentially two guys on this computer screen that you consider friends, and say, listen, I'm going to give you 70% of the deal. I'm going to take all the money off the front side, and there's going to be nothing left for you on the back side. And if it goes wrong, well, at least you own 70% of the deals. And that was a struggle for us. So what we did was we looked at the metric and we said, what's a fair return ultimately for them if we give them a preferred return, so they're getting money every month or every quarter, and what's fair overall based on the work for both people involved, and what if we charge no fees? So in our situation, we don't charge all these acquisition and management, disposition, you name it, fees. What we like to do is, we want to ride or die with you. So, and for us taking that risk with you, we do want to portion the deal. So in this specific deal, we were able to do an 80-20 split. And it worked out well. We're working on another deal where the metric is 75-25 at the end, and it's something different at the front side. It's all, the front side is 55-45 to be completely transparent. It's all what's right for you and people involved. And Jason saw what I went through on that other deal that we're working on. There's a lot of moving parts. There's a lot of risk. Those investors deserve an additional return for the risk that they're taking. So Oren, I would say I hate to say it, it's not what you can get away with. It's what's mutually beneficial to both involved. And I'm sure Chris and Jason can comment to this exact topic because they deal with it even on their hard money lending side of things.
Yeah. I mean, one thing is that in most of our day-to-day, we're looking at first mortgage liens, right? So we're talking like 10% under, something like that, more of a secure than an equity deal, right? So in my experience, a lot of equity people are looking for, I don't know, somewhere around 15-ish return. That's probably a good ballpark, isn't it, for an equity deal? And that could come from a preferred equity return. It could come from cash flow in the future, but something in that range, like 15 plus, seems to be about where the market of investors is, give or take.
Yeah, absolutely. And I think if you can back that return into what the ultimate equity split is, either you're going to retain some more or you're going to give up a lot more based on what that target number is of that 15, 20. Again, it's all, you could be involved with a lot of people that are doing retirement funds and they're only worried about getting 6%. There's a ton of different ways to cut this up. So again, it's easier just to be fair across the board and say, this is what the fair deal is. I understand the risk you're taking. How can we get the goal.
Yeah. And I think it depends on scale, how much access to capital you have, kind of how your capital stack, as they call it, is set up. I mean, listen, if you're doing a smaller project and it's $1 million and you're able to get leverage between a bank and somebody else, and maybe you only need $100,000, maybe you have a passive investor who just wants a good interest rate return. You don't have to give up any equity, maybe in the case. And like Ian said early on, a lot of these deals are split up that you give 70% away in equity, but then you set a fee structure. So I'm all about kind of not giving away the farm, but being pretty ambitious to your capital investors up front to make it a real win-win. And I know there's always the argument of, oh, well, you're doing I'm going to be doing all the heavy lifting. I'm going to be doing all the work. I mean, that's true, but you might not be able to get into this deal without it. And from our experience with raising capital, is all capital that you raise typically is just going to continue to churn with you and come back and grow and sprout from friends and family and other people. So the easiest way to raise more capital quickly is to take care of your investors, give them a high interest rate return, be transparent, and just keep growing and growing. I mean, and believe me, it's a very good feeling in the world when you make your investors a lot of money. And obviously, you're making your money on the way with them, but you make them a lot of money. It's a good feeling, and it's a long play, right? And anyone can make a quick buck in real estate investing, but it's the long play, and you want to make you want to stick around, and also you want to get to a point in the future, and this is hard to do at the beginning, but you want to get the goal of all this is in the future when a deal comes that has to close quickly, you can make a call, a text, meet somebody real quick and say, hey, I need $100,000 for this deal. You in? And they say yes. And that's not going to happen on day one, but in the future it will. So just go talk to lots of people and figure out kind of, what threshold they have. Here's what's the best strategy to fix split properties with no money or credit? In general, that might be the wrong question for us to answer. Do I believe it exists? Absolutely. I think all three of us have been involved in real estate where we didn't really have to put any of our own funds in place. But you got to go out and you have to go raise private capital. You're probably not going to get a hard money lender to give you 100% of everything. You're probably not going to get a bank to do that either. So there's two ways to do that. You either you go and you work with a bank or a hard money lender or somebody else, and you kind of get an easy transaction with easy capital that you're on the hook for, and you put money in, or you go capital raising mode and you work hard and you go try to raise the capital yourself. I'm not stating that you're not able to do it with no money down or credit. A lot of people on this call have done so, but at the same time, you got to go do the heavy lifting and go raise private capital to do so. Let's see. Let me look at some of these new comments that came in. Do you have any template worksheets that you can use to run? No problem. Hey, Ian, do you know the answer to this since Jason hopped off?
Yeah, so it's actually a quick approval process. You do have to go through a technical review, which can get really down in the weeds because you need to cut sheets and you need to have an understanding of what materials you're putting into the property. But if you can get through that, you can pretty much get through it. The other thing is that the CPACE loan will not close on the day that you close your loan. So there's also not that much of a rush necessary to get it done. And second, something else that we glazed over on Tucker's question is your money won't be distributed until the loan is recorded at the state level. So that's just something else to be cognizant of, especially in Baltimore City right now with everything going on.
Yeah, but how won't it close? Okay, so technically you don't need it to cover the proceeds of the seller because in this case. So I guess that's the case in all of them, right? I mean, that wouldn't be the case in all of them, but I guess you have to structure it to do so because, for instance,
you can't get a draw on day one. So you can't cover it for your equity. You can't cover it for the deal. But you can get retroactive on some stuff. And also, they're not taking a title insurance policy or a lender's insurance policy. You can pay for one, but they're not taking one on day one, so they won't release until you're officially recorded because they're getting service through the tax bill. So if you're not officially recorded, they can't get service because the tax bill is still going to the old owner, right?
Wait, so when you're making the payment, are you paying it through the way you would pay your taxes?
Correct.
And then in the tax, and they disperse it. Okay.
Assessment above and beyond the tax bill.
Got it. So Ian, would this deal that we're talking about be considered a syndication deal?
So this one, we actually did go through the process based on the amount of investors we had. Having a long talk, and everyone's getting a free lawyer lesson here because it cost us money. Her opinion was that if it was 5 or less partners, she would have been comfortable to just do it under an operating agreement, kind of similar to the next deal that I'm doing, where I only had to go to 2 capital investors. So everything's done through an operating agreement. The fact that we had more than 5 people involved, she felt much more comfortable by protecting everyone through a syndication agreement, and that's a $20,000 lesson there. So those syndication lawyers get very expensive very quick, but if that's what you need to do to protect yourself and more specifically protect your investors, that is the number one thing that you can do. So
Gotcha. But that's not legal advice. Someone should call their own attorney and ask them that. Or CPA.
Yeah.
Okay. When you're evaluating these properties, this is Levi's question. Are you basing things off cap rate, and then recent sales in the area?
So Levi, great question. We didn't necessarily value it on cap rate sales or in and around us, and I'll tell you why. What it came down to is, what's the cash flow look like? What does it look like for everyone involved in the deal, right? What mattered the most to us is, will the investors get their preferred return? Will there be cash flow and make this worth our while to bump all of our interest, all of our return cash? And to us, it didn't really matter what the recent sales were, because besides that phone call that we got that the person was like really up our butt about trying to get that property, I don't know that just knowing who our investors are, that if we could refinance this and return everyone's capital, I don't know that any of us really want to sell this deal. I think if we all could get consistent cash flow for a long period of time, all that other stuff's ancillary. I do think you need to understand the recent sales values. Granted, this one was a little different because I didn't need to get a comp. She was under financing 90% of it. So it's whatever she was comfortable with. Do I think you need to understand what's going on around you? Yes. You need to understand what other cap rates are to back out your numbers, to be able to present something or be able to refinance long term. Absolutely. Specifically, though, in this deal, that was not the number one most important thing. Most important here was cash flow and how we're going to get to the path to get to that cash flow.
Yeah, I mean, I think deals like this in general is a very different mindset than a regular fix and flip deal, because you have a fix and flip. The goal is to sell it, make the money, and move on, and there's no tax advantages in doing so, right? You're taking the money, and it's usually not super large sums. I mean, it's a good chunk, but it's not millions and millions of dollars. It's tens of thousands of dollars on a fix and flip, and unfortunately, you got to pay taxes on that and move on to the next one over and over and over. In doing so. But think about this. You sell a big building, and what ends up happening? You're splitting up a big. Taxes are very, very expensive on some of those. And then what do you have? You have the money. And don't get me wrong. Let's say you have a building and you sell it. You make $1.8 million in profit, and you walk away with $1 million, right? Everyone wants $1 million. But that being said, that might actually be more beneficial to keep the income producing building that's going to spit you out a steady rate of return. Because if you have that $1 million, what are you going to do? I mean, the responsible thing isn't just like, I'm going to go buy this and spend it all. Most people want to reinvest it. So that asset, you might not be able to find another asset to reinvest it as powerful and as good as this current asset you're in. Now, obviously, you can do a 1031, right? But then you obviously have to jump up asset classes and find a bigger and better one. So in general, I don't think plan A always is, hey, let's sell it so we can make $1 million. It might be figuring out a way to, hey, let's do this, and it's spitting out good income on a regular basis. So it's just something to think about. I don't think a lot of people think of it like that, because a lot of people have the mindset of, flipping houses, make money. Like, what do you do when you flip a house typically? You get a chunk of money, and then what do? You pay taxes on it, and then you go buy another property and do it the same way. And you know, if you look at the math over time, you know, you're taking 2 steps forward, 1 step back, 2 steps forward, 1 step back, 2 steps forward, 1 step back. Like it's complicated to do that. It takes a long period of time. Here we go, Ian. You can go through that one.
Yeah. So are you getting financing for the energy savings improvements? Also, will you get tax credits if you make the capital improvements that are sustainable, green, and et cetera? The last part, no, we're not looking for tax credits from the government. Maybe we could have done a better job researching that and digging deep. We were really looking to satisfy the bullet points to the C-PACE loan, and that's how we're financing all the energy improvements, you know, which was a lot of the improvements going on in the property anyway, i.e. toilets, lighting, roof, windows, all those things that are going to increase either water usage or decrease water usage or increase our value of the property is what we were able to utilize it for.
Got it.
A lot of silence on this one, huh?
Go ahead, Ian.
Well, you got ordinary income and you got passive tax. I'm not a expert as a tax. I would highly suggest you watch our interview with Jeff Cohen last week. But if you're flipping a house, you're subject to a lot more tax liability than if you were holding a rental property. Even if you sell that rental property, you know, you're talking about an 18% swing in the grand scheme of things between 38% self-employment tax and, you know, rental properties where you're taxed at a passive rate of return of 20%. So,
yep, I like this question. Go ahead. And there's another good question coming up next.
This is like speed fire round. Can I play Jeopardy? Can you put these up on a screen like that? It'd be easier. How do you determine what to offer on a small multifamily that's vacant, needs a full gut rehab with no NOI and no good comps? It sounds like you got a nice complicated math problem on your hand. If you're talking small as in 10 units, or are you talking small as in 2 units? If it's 2 units, I would just underwrite it as like a normal house. If you're local to Baltimore, we did a bunch over in, what is that, 21222, like the Dundalk area. We did a few over there that were just those 2-unit up and down apartments, and we just underwrote it like a normal house. If you're talking about a 10-unit, you know, 10-unit building, again, I would value, you got to look at it. That's where some of your other question came from of knowing what other values are around you, and you know what other cap rates potentially are. You know, ultimately, I would do it like I just do a house. I would start with what's the rent amount. I would figure out what the ultimate NOI is. You know, quick math. You know, you're talking 60, 40, 60% profit, 40% expense. Then I would figure out what a cap rate is. If it's 10%, you divide it by 10, or if it's 8%, divided by 0.08. That will give you a value of the property. And then I would say, well, I want to be in for X percent of that, say 75%. And then I'd back out all construction. And after you back out all your construction, that's what I would value it at. I do wish I had a whiteboard to show you that, but I would figure out what your NOI is. That would give you a value of the property, and then back out your construction costs. And that's ultimately what you'll come up with.
Yeah. I agree. I agree with that as well. And I mean, I think so many people try to get too complicated of what they believe the value as a property is. And all three of us probably have different opinions on what we believe the value of a property is. If you brought us a property today, we'd probably value it differently based on what our intent is, based on past knowledge and information and resources we have, based on what it's worth to us, right? Some projects are like, you know what? Like, think about with doing a 1-unit rental property. I think it was Aaron Foster that was on here once. He said, I don't care what the numbers are, percentage. Like, I'm not basing it off of a good percentage. I just want to make $500 a unit. Like, that's what his investment model is. I know, Ian, you're very like IRR and you know, try to categorize it by that, and that's fine as well. But like, for instance, like, let's say, you deploy $5,000 and you make a 20% interest on it. It's like, it's not a ton of money. Chris and I are more of the philosophy of like, hey, is the deal worth our time? How much money are we going to make on that deal? If we got to deploy capital into deals, if we're going to be invested in the deal, like, is it worth it? Do we want to invest $100,000 into a project, and make $2,000 in, a few months? Probably not, right? It just doesn't make sense. Even if the interest rate return could potentially be high, because it gets paid off on a quicker basis, right? But let's go to, thank you.
All right. When analyzing value-add apartment deals, do you have a bottom number increased rent per unit, or say $250 or $400 per door? So, Edward, I am assuming you're saying, well, what's the increased value? So, the deal we did out in West Virginia, it was a $300 increase. The deal we're doing here in Baltimore, it's anywhere from $150 to $250 per door increase. Ultimately, it's a metric of what you're investing into it. So the way we look at it is we don't really get down into that nitty gritty. And this kind of goes back to what Jay was just talking about, is there's times to be fast and loose to quickly underwrite a deal. And there's other times to really get deep into the weeds. For us on this deal, we knew that we could get to $1,000 rent on average. So we knew what our rent roll was going to be. And then we said, well, how much in capital improvements does it need? Does this make sense? Is there still a good capital, cap rate or rate of return for everybody involved? Excuse me. On the backside, and that's how we backed into it. A lot of times you hear from the bigger apartment investors, I want to say for every $100 they like to only invest, I think it's like 1 to 2.5. I think for every $2,500 they put in, I think they have $100 of increased rent per unit. But don't quote me on that. I'm sure you can go stalk Summerrock or Bratz or one of them guys, Michael Block, and you can really get the nitty gritty. But there is a metric that they like to use. I'll be honest, we're a little more, we're less in the weeds and more in the let's just get the deal done. We know we can perform.
Got it. Cool. Cool. Ian, certainly appreciate it. If you don't know Ian's contact at Equity Warehouse, you want to comment that below if anyone wants to get a hold of you?
Yeah, sure. I will put it in.
Let's do one last question. We can answer questions after the fact. This is an ever-going, feed, however you're watching it. So we can hop in afterwards and answer it. Let's just do one last question. Let's see. So that's Ian's stuff.
Depends if you're the buyer or the seller, right?
Yeah. So what's considered a good cap rate? Well, let's use what is a cap rate? It's a return. It's your capitalized rate of return, right? So let's just do it this way. Let's say Jason got me sidetracked. You wanted me to comment. What's a good cap rate? So a good cap rate, do you want to make 5% on your money? So the cap rate of the deal is, if you bought that deal in cash, you would make 5%. If a good cap rate is 10%, you bought that deal in cash for $1 million, you would return 10% that year from what you're buying it at it on day one with no improvements. So you would make $100,000 that year if you put out $1 million without financing. So you just need to say, well, what's good for you? That's where people get into the leveraged return, pace, increasing your leverage piece. Like this deal, we're able to offer a little bit more because it was so highly levered based on what the seller was willing to do, right? And that's really just what you need to look at. So if you're the buyer, we like to get above double digits. So we start, if we see something that's cash return of 7 or 8%, we know when we lever that up, we can get double digit returns. When you're selling, obviously, whatever the market is, in the apartment world, you're probably talking mid 6s, low 7s, somewhere in there. In our marketplace, especially for where this property is asset class wise, I think we did a good video with Justin Werner a while back where we discussed this at length. You got anything else on that?
Yeah.
Yeah. Also, it gets a little funky on the seller side too, because it becomes somewhat subjective. Instead of like a buyer looking at their numbers on the straight cash flow of a property, they might be looking at, oh, they're building this next door, or they're putting a metro station here or whatever, and they're going to take their, 10 cap return and try to sell it for a 6 cap, right? So it is a subjective number oftentimes, and different between the buyer and the seller. But yeah, just to echo Ian's point before, in terms of being a buyer and just working the numbers, it's your rate of return. It's the rate of return of what you're putting into the deal.
Yep. Well, everybody, appreciate you coming out, or sitting at your home or wherever you are watching. That's it's always a good way to do it as well. Hopefully in the near future we will all be together again with some ice cold beers or drink of choice at a local restaurant to do this. But you know what? It's not the worst thing in the world to be able to communicate this way. I think a lot of us have adapted as this is the new norm to be able to congregate in large groups. You don't get the full feeling, but the cool part is you can get through some of this stuff very, very quickly. So again, we appreciate it. If you need anything, feel free to reach out to us at Hard Money Bankers. Ian, thanks for tuning in. I don't know what that noise was in the background. Tuning in. Yeah. You can find him at equitywarehouse.com. Just going to go through a few of these. Thanks, guys, for supporting the real estate investor meetup group. Appreciate all you guys. I'm glad you guys found it informative. Thanks, guys. Yeah, appreciate it. Certainly appreciate it. So yeah, we're going to try to do this on a regular basis, the third Wednesday every month. Don't worry, we'll remind you through the Meetup site and through other channels. And yeah, hopefully we got some good speakers ahead. If anyone has any recommendations of topics that they want to hear about, obviously we know that there's a lot of sexy topics related to finding capital and finding deals and things like that. And certainly happy to go through all that. But any other things related to whatever accounting purposes, insurance stuff, the legal aspects, maybe kind of secrets in finding off-market deals, because obviously we know deal flow is really, really hard right now. Although I think we can all kind of tell you firsthand that, we've seen a lot of really good opportunities. I mean, listen, Ian just bought that 76-unit apartment that was all seller financed, 90% seller financed in the middle of COVID, right? Like, stuff's out there. As lenders, I mean, we still do our 25 plus loans a month, and we see the buys that our clients are buying as we do loans for them. They're really good opportunities. They're still out there. It might not be falling in your lap, but they're out there. And one thing I think all three of us can attest to is if you have a good opportunity, money will follow. It just will. You'll find capital. It might not be the capital. It might not be at the terms you exactly want. And the investor might not just be throwing free capital at you, but it's out there. Between local banks lending, hard money lending, there's a lot of active private lenders out there that are trying to deploy their own money with other local real estate investors, because they just don't want to be a landlord. They don't want to do deals themselves. They can't find deals. So it might be easier for them to just deploy it to you, but got to work hard and you got to be out there and you got to take it seriously. I think too many people don't treat this like the business that it really is. And I think all of us can attest that, this is a full-time job. It's a full-time business, and it's got to be treated like one, because if you don't treat it like one, it's just not going to go anywhere. So any last words, fellas?
No, I think that's about it. Thanks to everyone for stopping by, participating in the meetup, coming back.
Excellent, guys. If you need anything, feel free to reach out. And if you enjoyed this real estate investing incubator virtual meetup group, please feel free to tell your friends and share some of these links if you're watching on LinkedIn or Facebook or YouTube or on any of our sites. Thanks again, and we'll talk soon.